Hey everyone, I hope that you all took a small break from the market craziness from the past 2 weeks and you managed to buy smart into those dips. And if you happen to see my update, I took a little bit of a social media detox and I loved it. As I had mentioned in my very first video, I retired at 46 because you need to be present to win. And for me, building wealth is about freedom of time to do what I want when I want. And I want all of you to have that same level of freedom. So let's go over my shopping list for August and the companies that have been buying on the dip or market correction depending on the company. And I'm going to change up the format just a little bit. I'll cover a handful of the companies and why they're worth buying right now. And at the end, then I'll share what percentage that I bought into them. And I happen to be reviewing them in no particular order. My first company to discuss happens to be Supermicro Computers, which is part of the second tier of AI that's focused on the expansion infrastructure. And don't worry, I'll create a dedicated video speaking to the software or the third phase of AI at a little bit of a later date. As for Supermicro, they design server architectures and they offer physical servers, storage systems, and server management software. And they happen to be leading the pack with their liquid cooling solutions, which will be a growth engine with the AI customers. So why did I choose Supermicro Computers? Well, they had their quarterly results a couple weeks ago and they missed on margin, and the stock has tumbled roughly 30% from their high. And clearly, this opens up the door for investors that thought it was too expensive to invest in the past. In those quarterly earnings report, the revenue was at $5.31 billion, which was more than double that of the prior year, but its margin came in at 11.2% compared to the 17% from the prior year. And this margin miss was the leading cause for the massive drop in their stock price. So what caused their margins to drop by so much? Well, a lot of it has to do with competitive pressure from both Dell and HP, all bidding down on the prices. They also stated that component costs from their suppliers had also increased, but they had chosen not to pass on those costs to their customers. And some of their customers have been building servers in-house and then cherry-picking the products from Supermicro, which of course then dilutes their margins. Overall, I feel this is a good problem to have because there is a clear path ahead. Look, I've managed billion-dollar businesses in the corporate world, and I left as a vice president where I had been having very similar financial discussions just like this. Supermicro is going to double down on negotiations within their supplier network. And then next, they're going to change their pricing structure where component costs are going to increase substantially versus when they buy things as a package deal. So all of those cherry pickers building their own servers are going to be paying a little bit more in the future. That path will materialize in their upcoming quarter, where they've already forecasted between 6 and 7 billion in revenue, which far surpasses analyst forecasts of 5.46 billion. But the clincher is that the earnings per share projections from Supermicro has a midpoint of $7.48, which is much higher than the $6.25 from this last quarter. And the reason why I like this stock is because the demand is off the charts, and it shows clearly in their revenue. And if they can manage to tweak their margins to correct, then they have huge potential. Analysts have the 12-month projected stock price at just under $1,000, but it's trading today, during the time of this recording, at $505. If that holds true, then it has an upside of 93%. Most companies fight to have revenue growth with solid margins, and Supermicro only needs to manage their margin improvement to get back on track. So definitely keep your eye on this one. And here's the thing. Managing margins during high inflation, it happens to be difficult for every company and their cash flow. But I think that there's several of you out there that I think you figured it out that real estate can pay back way better than dividend stocks with the cash flow. And of course, the appreciation can be a huge win when you sell. But a problem that I personally have with real estate is the huge amount of capital and debt that we take on as individuals. But what if you could pool your money together with a group of investors and buy a 100+ unit rental where experts do all of the work and the planning, where the average cash flow return is 8% annually and 100% return on investment at 5 years when it sells? Well, that's exactly what Compass Capital is doing, and they're taking on accredited investors to be part of their already $100 million in assets for rental properties. They buy larger rental units selling at a discount. They update the facility to improve the rental cash flow, and then they work to sell the investment in around 5 years. And there's way more details that I don't have time to cover, but you can invest as an LLC, a trust, or even with a self-directed IRA. If you're interested, I have a link down below where you can speak with someone like Sam that is a managing partner within the firm, and he can discuss the opportunity further. The next company is Palantir. And what can I say? I absolutely love this company. They are one of the few software-specific companies focused on AI that have figured out the secret sauce. And for those of you that are not familiar with Palantir, they had primarily created AI platforms specific to government and military. But they began a hard push last year to increase their commercial customers. Essentially, they have a platform that sits on top of a company's existing system, and it creates a localized large language model using company-specific data, analytics, and processes. But it's way more than a chatbot. It's true automation company-wide. They happen to offer 4 main products of AIP, which is Artificial Intelligence Program, Foundry, an operating system for enterprise, Gotham, an operating system at the global level, and Apollo, which is an operating system with continuous delivery. And as for their success, they have a case study where a company realized a cost savings of $50 million within the first 2 weeks of implementing their Palantir system. Truly, it is an amazing system, and I believe that most every major company, they're going to need systems just like it within 10 years just to be competitive. As I had mentioned, Palantir began pushing hard into the commercial sector last year, and I was trying to beat my drum as hard as I could to share that with the rest of the world because I knew that once they pushed into commercial, they begin to make a major profit. And that's exactly what happened. And as for today, well, during the pullback over the past couple of weeks, Palantir did drop down to $21. And then they released their quarterly earnings and was quickly up near $30. That's nearly a 50% change in less than a week. Seriously, I hope that you took advantage of it because since then, Palantir announced a partnership with Microsoft, which is going to give them even more momentum. I don't have much more to say about Palantir, but there are 2 areas that I do want them to improve on, and that happens to be their marketing and then also their deployment strategy. Hardly anyone knows about Palantir because, well, their marketing, it's just really poor. And they also lack a network of third-party groups that manage their deployment of the software. This is an area where, honestly, they need to take a note out of Salesforce's playbook. If they can focus on those 2 things, then they will be unstoppable. The next company that was at the top of my list during the dip, may surprise you, it was Intel.
What? What'd you say?
Okay, I am totally kidding. I hope I didn't lose anybody when I said that, but no, Intel was not on my list at all. Several weeks ago, I laid it out in this video right here where I gave my opinion on Intel. And if you're wondering when I suggested I would invest back into Intel, here, hold my beer. Alexa, set a reminder for January 2026. Look into Intel and consider whether or not you want to invest in them. I wouldn't be surprised if their CEO was fired within the next 8 to 10 months. And of course, it'll take a year for the next leadership team to begin to make an impact. So 2026. That and their foundries business, well, it should be fired up and running in a big way by then. And it is such a huge investment that it's like an aircraft carrier that it's not going to be turning around anytime soon. But coming back to reality, my next company is Nvidia. I'd captured a lot of profit and I sold roughly 40% of my position when it was at about $130. And during the dip, I was able to pick up more at $96, which I thought was a very good value. I believe that all of you know about Nvidia and the fact that they are the #1 developer of GPUs or graphical processing units, which are the heart and the brains of AI and machine learning. And many of us are familiar with their graphics cards in our computers because, well, they just happen to be the best and also ridiculously expensive. As for their business, they tumbled during the dip last week and they dropped down to roughly $92. And then they'd been in a slow decline leading up to last week. And that's okay. It had been running very hot for a very long time. Some of the drop was associated with their news that their Blackwell chips, which are replacing the H100s, had a design flaw, and that would push out the launch to 2025. And those changes really shouldn't make any impact on their quarterly report on August 28th, since it wasn't accounting for Blackwell anyways. If anything, their fourth quarter may be a bit underwhelming, and it could hurt the stock price just a little bit, and I'd see that as another buying opportunity. Because let me tell you, Q1 of next year should be stellar with their Blackwell chips being fully pushed out into the market. But hey, we will all find out together next year. And the next company is Intuitive Surgical with the symbol ISRG. Now, I've talked about this company a few times over the past year, where they're known for their robotics surgical system called 𝐓𝐸, where it's an entire robotic platform that can perform complex procedures with enhanced vision and control. And I find it shocking that they have been used in over 10 million surgeries across more than 67 countries worldwide. These systems are less intrusive, they're sterile, and they give a new level of precision to surgeons that are working on very complicated areas. I realize that this stock may be completely outside of my normal AI-focused stocks, but the robotics side really sort of fits into the mold. I like that this marries up the health sector along with technology. And those are two areas that will only keep increasing in demand over time. In fact, their latest quarterly results had a growth of 14% year over year at $2 billion, and the company is sitting on over $7 billion in cash to reinvest in itself. I see IRSG as good potential because it happens to be part of the health sector and technology, which tends to do very well during market downturns. And during the dip of last week, it was down to $432, and now it's well up over $463 during the taping of this video. Now, it didn't drop nearly as much as other companies, and it didn't rebound quite as high either. This is sort of my go-to cash cow that happens to have great stability over time. So you're probably wondering now, at what percentage did I invest across all of these? Well, here's my breakdown. Nvidia was at 55%, Supermicro 20%, Intel hard pass, Palantir 19%, and ISRG was 6%. I certainly hope that I've earned a thumbs up for my video, and I'd love it if you'd consider subscribing to the channel or even my newsletter linked down in the description. Thanks so much for watching.